Hello friends, and welcome to this month's edition of Matters Relating to Markets and Investments. As we speak, the markets continue to power on and hit new highs, and the fear of heights continue to bother investors. However, the markets survived one more scare, and that was the tightening by the US Central Bank, the Federal Reserve. Every investor was waiting to hear what happens at the Jackson Hole meeting of the Fed. And finally, what came out of that was that A, the Fed believes that inflation is transitory. There are a lot of supply bottlenecks which are causing inflation, which is not likely to last, as some of these bottlenecks will get resolved over the next couple of months and quarters. Then there is a threat of the Delta variant, which is again beginning to have some impact on employment in the short to medium term. And we saw that the February employment report was far below consensus. And therefore, it looks like that central banks are likely to be in a wait and watch mode. Just to give you a perspective that we are still far away from central banks raising interest rates. But we'll come to that later. The first step in unwinding the stimulus will be to reduce the Fed's bond buying program. Currently, the Fed buys approximately $120 billion of bonds every month. Yes, which means that they print $120 billion of new money every month is poured into the system by buying bonds and releasing dollars into the market. And just to give you a perspective, during the global financial crisis, the Fed's balance sheet went from 1 trillion to just over 2 trillion. And during the coronavirus pandemic, the Fed's balance sheet has gone from 4 trillion of the central banks to over 8 trillion. So there is still a large amount of liquidity which is going around. And even if the Fed was to decide to reduce the amount of bonds that it buys every day, what is likely to change is just the rate of bond buying. Having said that, the cumulative liquidity will still continue to power on. So our belief is, and I've said this in several occasions over the last few months, that while global interest rates and liquidity continue to remain reasonably benign, being one large factor for the markets to be where they are, we also believe, on the other hand, that it is a very strong set of corporate earnings which is equally important to talk about where markets are. And therefore, it's not just liquidity, but even fundamentals, which is the reason why markets are where they are. We have done a little study of past phases when the Fed has tightened interest rates. Now, usually what happens is that the Fed tightening of interest rates is usually coincided with a very strong economy. And if you look at two such previous occasions, one from May 4 to September 6, when the absolute change in the Fed funds rate was almost 430 basis points, which means that the Fed between May 4 and September 6 raised rates by 400 basis points. The Nifty returns in dollar terms were 45% positive. The MSCI Emerging Markets Index in dollar terms was up 29%, and the MSCI Global Markets were up 13%. Similarly, if you remember, there was a taper tantrum in 2013, but the Fed finally started to raise rates only in October 16. And while the Fed raised rates between October 16 and April 19, which is from by about 237 basis points this time as well, Nifty was up in dollar terms by 11. The emerging markets was up by 9%, and the MSCI global returns were up by 8%. So in the past two cycles, in fact, the Indian markets, emerging markets, and global markets have all actually given positive returns while the Fed was tightening in its cycle. Why does this happen? Because the Fed typically tends to tighten when it believes that the economy is picking up and inflationary forces are picking up because of the strong economy. What the Fed believes currently is that while the economy is picked up, it has not reached its full potential, both in terms of unemployment and in terms of output, and the recent spike in inflation is more transitory in nature. And therefore, I think that the constant fear that we have that a slight Fed tightening could lead to a fall in the markets, in our opinion, is not really true when we look at the data. But yes, whenever the Fed decides to reduce its bond buying, there could be volatility in the markets, and I think one should be mentally prepared for that. One of the interesting facts is that with the crackdown on the tech companies in China and with China slowing down, I think one of the biggest beneficiaries of that has been India. And if you look at the numbers, year to date, Korea has seen outflows of about 26 billion, Taiwan about 16 billion, Philippines 1.7 billion, only Indonesia got a positive 1.6 billion, Thailand minus 3 billion, Malaysia minus 1.1 billion, and India is a staggering positive 7.5 billion in calendar 2021. So what I'm trying to say here is that India is likely to be a significant beneficiary of FII flows into Asia, ex-China. And we believe that if the sentiment towards China continues to be negative, and in the recent times it has been because of the strategic shift that the Chinese Communist Party has made in terms of policy towards the big Chinese tech companies and the internet companies, we believe that India should continue to see a benefit in terms of FII flows. Back home closer, what we believe is that, as we have been saying in the past, that despite above average valuations, we continue to remain positive on the Indian market because these average valuations need to be seen in context with where we are in the earnings cycle. All the previous peaks were led by subsequent periods when actually earnings fell. We believe we are entering a new earnings growth cycle, and therefore the current valuations will correct itself because earnings should surprise on the upside. And then, let me repeat, there are several other reasons why we continue to remain reasonably positive on markets. One is that we've continued to see deleveraging by corporate India and balance sheets becoming better and better. We believe we are seeing a new real estate and property cycle with a broader capex cycle to start sooner rather than later. The government's pro-growth policies, its focus on manufacturing through the various PLI schemes, and its now prioritizing selling government assets, monetizing government assets, and spending on infrastructure to reflate the economy. A continued accommodative monetary policy with RBI prioritizing growth over inflation after a very long time, and easy availability of capital from both private and public markets eager to back young entrepreneurs. With all these reasons, the starting of a new economic and earnings growth cycle, reasonable liquidity, and low interest rates would mean that the markets would continue to climb the wall of worry. With this, as we have said in the past, we believe that we are fairly convinced of the long-term trajectory of the markets. We will be ready to take any short-term volatility. Yes, there could be corrections along the way, but there are too many structural factors today which are positive for markets than we have had in a long time. So friends, our message continues to be invest with conviction, and we believe that markets will continue to climb all walls of worry. With that, thank you.